Every single morning, millions of Americans wake up, go to work, and hand a quiet piece of their paycheck to an institution they barely think about. Not the government, not their landlord, their bank. And the worst part? Most people not only accept it, they thank the bank for the privilege. This is not an accident. This is a system. And today, you're going to see exactly how it works. Here is something most financial literacy classes never teach you. Banks are not your friends. They are not a public service. They are not a safety net. Banks are businesses. Highly profitable, deeply sophisticated businesses built on one core principle. Your money is more valuable in their hands than in yours. But most people do not see it that way. They see a free checking account and feel like they won. They see a mortgage and feel like they accomplished something. They see a credit card with rewards points and feel like they are beating the system. Meanwhile, the bank sees a customer, a source of yield, a product wrapped in the illusion of a relationship. In 2023 alone, the top U.S. banks collectively earned hundreds of billions of dollars in revenue. J.P. Morgan Chase posted over $49 billion in net income in a single year. That money did not come from thin air. It came from you. From your deposits, your loans, your swipes, your late payments, your financial confusion. The tragedy is not that banks make money. That is capitalism. The tragedy is that almost nobody understands how they do it, and that ignorance costs the average American thousands of dollars every year without them even noticing. Let us start at the very beginning. When you deposit money into your bank account, you probably imagine it sitting there, waiting for you. A digital vault. Your money, safely stored. That is not what happens. The moment your paycheck hits that account, the bank puts it to work. They lend it out to other people at a higher interest rate than they ever pay you. This is called the net interest margin, and it is the oldest trick in banking. You might earn 0.01% on your savings account. The bank turns around and lends that same money at 7, 8, even 24% on a credit card. That gap, that spread between what they pay you and what they charge others, is their first and most fundamental profit engine. This is called fractional reserve banking. Banks are only required to hold a fraction of your deposits in reserve. The rest gets loaned out, invested, and leveraged. Your $10,000 in savings might effectively generate $80,000 or $90,000 in loans somewhere in the system. You get a 0.01% return. They get the rest. But interest margins are just the beginning. Think about the last time you used your credit card to buy something. Let us say you bought a $100 pair of shoes. The merchant received roughly $97 to $98 of that. The bank quietly took 2 to 3% as an interchange fee. You did not see it. The merchant paid it. And it happened billions of times yesterday across the country. Visa and MasterCard processed over 100 billion transactions last year. That is a river of money flowing into the banking system on every single purchase, every single day. Then there are overdraft fees, monthly maintenance fees, wire transfer fees, ATM fees, foreign transaction fees. The industry generates tens of billions of dollars annually from these charges alone. They're designed to look small, almost trivial. $15 here, $35 there. But across 150 million account holders, small numbers become staggering ones. And then there is the masterpiece of modern banking, the credit card. The average American carries over $6,000 in credit card debt. The average interest rate on that debt sits above 20%. If you make minimum payments on $6,000 at 20% interest, you will spend years paying it off and hand the bank thousands in interest on purchases you already made and likely already forgot about. The bank does not want you to pay off your balance. The bank wants you to carry it. Every month you carry a balance, you are a revenue stream. This system did not happen by accident. It was engineered. Banks spend enormous amounts of money on behavioral psychology. They study how people make financial decisions, what triggers impulsive spending, what makes someone feel rewarded even when they're losing. The rewards points on your credit card are not generosity. They are a calculated investment. Research consistently shows that people spend more with credit cards than with cash. The act of swiping is psychologically disconnected from the pain of spending real money. Banks know this. They built that disconnection on purpose. The checking account marketed as free is free for a reason. It hooks you into the ecosystem. Once your paycheck deposits there, your bills auto-pay from there, your debit card lives there, and switching feels like a massive inconvenience. Banks call this stickiness. Economists call it switching costs. The result is the same. You stay, and they keep collecting. There is also the deeper issue of financial education in America. The school system does not teach personal finance in any meaningful way. Most people graduate without ever understanding compound interest, credit utilization, or what a bank actually does with their money. And that gap in knowledge is worth billions to the financial industry every single year. An informed customer is a less profitable customer.
Think about that.
None of this means you are powerless. It means you need to start thinking about banking the way banks think about you. Strategically. First, stop keeping significant savings in a big bank's standard savings account earning essentially nothing. High-yield savings accounts at online banks have offer rates 15 to 20 times higher than traditional banks during recent years. Your money should be working harder than 0.01% while someone else lends it at 8%. Second, understand credit cards as tools, not lifestyle supplements. If you pay your balance in full every month, you use the bank's money for 30 days for free and collect their rewards. The moment you carry a balance, the math flips entirely, and they are using you. Third, look at every fee on your bank statement. Negotiate them. Switch if you cannot eliminate them. Credit unions, which are member-owned and not-for-profit, consistently offer lower fees and better rates than commercial banks. Most people have never even considered one. Fourth, build the habit of understanding where your money actually goes. Not in a vague, budgeting app kind of way. Deeply. Know your interest rates. Know your terms. Know what you signed. The financial industry profits most from the people who never read the fine print, because the fine print is where the business model lives. The wealthy are not wealthy because they earn more and spend the same. Many of them are wealthy because they understand the system well enough to stop feeding it unnecessarily. They automate savings before spending. They treat credit as leverage, not lifestyle. They see banks as a tool to be used, not a relationship to be trusted. Here is what it comes down to. The bank branch on the corner of your street, with its marble floors and its friendly tellers and its logo you have trusted since childhood, is a profit-maximizing business. It is not evil, but it is not neutral, and it is certainly not on your side. Every product it offers was designed by people whose job it is to extract maximum value from your financial behavior. The question is not whether banks will keep making money. They will. The question is how much of that money comes from you, and whether you're going to keep handing it over without thinking. Financial freedom does not begin with a high salary or a lucky investment. It begins the moment you stop being a product and start being a participant. It begins the moment you understand the machine well enough to stop being one of its parts. The system is not going to change, but you can.